Welcome to the best investment writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hello, this is Sahil Mahtani. I'm the director of the Investment Institute at 91. 91 is an active global investment manager aiming to deliver long-term investment returns for our clients, and we were established in South Africa in 1991. We were once a startup focused on domestic investments in an emerging market, but have since grown into a global firm. One thing that sets us apart is our commitment to developing specialist investment teams organically. That, and our emerging market heritage, gives us, we believe, a different lens on investing. Now let's get into the episode. I'm going to read a piece that I've written titled "The Unstoppable Dollar Meets the Immovable Mr. Trump." The gist of the piece is that financial history tells us that there are now enough shocks, we think, to decisively end the 2011 to 2025 dollar upcycle. Are we now in a cyclical dollar bear market? There are certainly reasons to think so. Yet turning points in dollar cycles are rarely obvious. We in financial markets thought it was upon us in 2017 and 2021 and were wrong. They defy easy prediction, often emerging only after macro, financial, and geopolitical forces have already begun to shift. That said, the convergence of those forces may be underway. Structural overvaluation, fading yield advantages, and tentative signs of capital reallocation all point to a possible turning point. Add to that a renewed Trump shock, tariffs, fiscal largesse, Fed pressure, and the ingredients for reversal become clearer. We explore how and why those forces may be fading and what it would take to confirm a genuine turning point. The paper outlines the structural foundations of dollar inertia, the historical triggers that have broken it, and the emerging parallels that suggest this cycle may be nearing its end. Dollar cycles are unusually long-lived, averaging around 18 years from peak to trough. We've had 3 up cycles and 3 down cycles since 1970. A chart of real dollar trade weighted, which we use instead of DXY to better reflect actual trade volumes with the US and is also inflation adjusted, illustrates the duration and magnitude of each dollar cycle since 1970, highlighting just how extended the current cycle has become. The 3 down cycles happened in 1970 to 1978, 1985 to 1992, 2002 to 2011, and the 3 up cycles took place from 1978 to 1985, 1992 to 2002, and 2011 to the present. In other words, the down cycles lasted 8, 8, and 9 years, while the up cycles lasted 4, 10, and 14 years, with a combined average of 18 years. This longevity stands in stark contrast to other macroeconomic and financial cycles. Business cycles average around 7 years, domestic credit cycles around 11, and equity and commodity cycles closer to 7. Dollar cycles, in other words, are simply different. They tend to be slower to form, harder to break, and longer to unwind. Dollar cycles endure because they are supported by 4 mutually reinforcing forces. Each has its own weight, but together they give the dollar a kind of momentum rarely seen in other financial assets. The first force is structural inertia from the dollar's dominant role in trade, geopolitics, and technology. The dollar is entrenched across trade, finance, and global reserves. It accounts for nearly 90% of FX transactions, around 80% of global oil trade, over half of global reserves, and a majority of cross-border banking and bond issuance. The dollar is the dominant vehicle currency, even for financial trades involving countries that border the Eurozone. For example, a trade from Turkish lira to the Bulgarian lev. In global trade, the dollar is over 50% of trade invoicing, and that is an understatement because it counts trade between Eurozone members as international trade. Excluding the Eurozone, the dollar share would be far higher. For instance, over 85% of India's trade is in dollars. This embedded dominance creates a persistent, diversified demand for dollars, largely insulated from short-term fluctuations in US fundamentals. The second reason is that the world rarely moves in sync. Policy divergence can last for years. While the US may be expanding and tightening policy, other major economies like Europe, Japan, or China may be stagnating, easing, or undergoing structural adjustments. These divergences, shaped by deeper trends like demographics, productivity differentials, or investment cycles, sustain interest rate and growth gaps over time. For example, US 10-year yields have exceeded German equivalents by up to 9 percentage points for much of the past 2 decades. These persistent differentials continue to attract capital flows, reinforcing the dollar's strength and lengthening the dollar cycle. Third reason is that capital flows take time to turn. Large cross-border reallocations of capital are slow to build and slower to reverse. International investors typically wait for policy clarity or confirmation of economic trends before making strategic moves. But once they do, inflows generate a feedback loop. Stronger asset prices boost returns and attract more capital, supporting the dollar. These loops can last for years. For instance, cross-border capital flows that participated in the US tech boom of the late 1990s or the EM boom of the early 2000s took time to ramp up and were bolstered by the feedback loop above. Finally, no one is in charge. Unlike domestic cycles where monetary and fiscal authorities intervene to correct imbalances, there is no global authority that manages currency misalignments. The dollar can become significantly overvalued or undervalued without triggering intervention. The 1985 Plaza Accord, where the G5 coordinated to weaken the dollar, was a rare exception. Without such mechanisms, cycles extend until the underlying imbalances become too large to ignore. In recent times, these have only gone into reverse after financial crises. Even then, the underlying institutional dynamics behind global savings and investment imbalances have tended to reassert themselves once the dust settles, allowing dollar inertia to resume. George Soros's famous imperial circle is one way of understanding dollar inertia. In his framing, persistent US budget deficits push up interest rates, attracting capital into the dollar and reinforcing its strength. That strength, in turn, makes it easier for the US to finance further deficits, thereby creating a self-reinforcing cycle that persists until something breaks it. Ultimately, all of these four forces, geopolitics and geoeconomics, asynchronous macro conditions, slow-moving capital flows, and lack of corrective oversight, explain why dollar cycles are unusually long, have a lot of inertia, and are surprisingly hard to time if you're looking for the turn. From here, we examine what it takes to break dollar inertia, turning to history and the common patterns that have accompanied every major inflection point since 1970. What breaks dollar inertia? Lessons from history. History shows that dollar cycles don't simply fade, they break. And when they do, it's usually because all four structural forces shift in close succession. Trade and geopolitical dynamics, growth and interest rate differentials, cross-border investment flows, and some form of FX adjustment, whether coordinated or market-driven. Since 1970, 3 full dollar cycles have unfolded. While the trigger points differ, the pattern is strikingly consistent. When the underlying macro, market, and policy forces turn, usually within a 2 to 3 year window, the dollar trend reverses decisively. The transition is often amplified by feedback loops and repositioning. What follows is typically a self-sustaining cycle in the other direction. We examine each major turning point since Bretton Woods. 1968 to 1971, the Nixon shock and the collapse of Bretton Woods. By the end of the 1960s, the US current account surplus had vanished, while Vietnam War spending had pushed far more dollars into global circulation than could be backed by gold. Confidence in the $35 peg began to erode. By 1968, the London Gold Pool, which was a multilateral effort to stabilize the gold price, collapsed under the weight of persistent European withdrawals, especially by France. The US imposed capital controls soon after, and the euro-dollar market expanded rapidly, driven by offshore holdings and a loosening of financial restrictions. Although this wasn't yet a period of large-scale private sector investment flows, the euro-dollar system made the dollar more vulnerable to confidence shifts. Nixon's suspension of convertibility in August 1971, backed by a 10% import surcharge, formalized the collapse of that system. The December 1971 Smithsonian Agreement devalued the dollar and introduced a narrow trading band, but the regime didn't hold. By 73, floating exchange rates had arrived. Classic rate and growth differentials also played a role. As the US entered a stagflationary recession in 1969-71, growth in Germany and Japan held up, and they also maintained tighter monetary policy. The Fed, under Arthur Burns, focused on recession risks rather than inflation. Past the initial break, the dollar down cycle persisted, fueled by negative real yields, rising inflation, and geopolitical shocks. The Yom Kippur War in 1973 quadrupled oil prices and widened the US twin deficit. Productivity collapsed, and confidence in the dollar weakened further. Central banks quietly diversified reserves, while US investors turned to commodities as an inflation hedge. 1984 to 1986, Plaza Accord and the down cycle turning point. By the mid-1980s, the dollar's surge had become a problem. Reagan's fiscal expansion and the strong dollar policy of the early 1980s had pushed the currency sharply higher, just as the US economy emerged from recession. Twin deficits soared, peaking at 15% of GDP by 1987, US exporters lost competitiveness and trade protectionism gained traction. In September 85, the G5 signed the Plaza Accord to reverse the dollar's rise and address competitiveness. The Trade and Tariff Act of 1984 had already given the administration new tools to manage trade imbalances, building on earlier voluntary export restraints which Japan introduced in 1981. The policy worked. The dollar fell by 35% over the following year. A major reallocation of global capital reinforced the adjustment. Japanese and European equities dramatically outperformed Japan by 160% and Europe, Australia, and the Far East, or EFI, by 100% over the 2 years following the accord. Commodities also began a multi-year rally. Meanwhile, US real interest rates fell and inflation expectations broke down, lowering the dollar's yield advantage. After the initial move, the down cycle persisted. US rates normalized post-Volcker, while capital flowed into booming emerging markets. Europe and Japan soaked up global flows, even as many emerging markets struggled with debt restructuring. All four forces, policy, growth differentials, investment flows, and currency action, moved together. 2001 to 2002, EM forever, another down cycle turning point. This turning point came as the US lost its growth and yield advantage. The dot-com bust sent the Nasdaq down 50% between January and April 2001, eroding wealth and cutting capital spending. In response, the Fed cut rates 11 times between Jan 2001 and June 2003, eventually reaching 1%. At the same time, the Economic Growth and Tax Relief Reconciliation Act of June 2001, known as the Bush tax cuts, and increased post-9/11 security spending marked the end of the Clinton surpluses and the return of widening fiscal deficits, while the current account deficit hovered near 4%. The war on terror and the run-up to the Iraq War marked a more assertive US foreign policy, straining relationships with allies. Meanwhile, structural shifts abroad began to take hold. China's WTO accession in December 2001 triggered a powerful EM export cycle. The euro became a credible reserve currency with the introduction of physical notes and coins in 2002, bolstered by central bank purchases. Capital began to reallocate. EM equities outperformed the US by 22 percentage points in 2001 to 2002. Commodity-linked currencies gained ground, and the euro rose 25% from mid-2001. Private sector demand for treasuries softened, even as official reserve buying persisted. The current account deficit began to weigh. What followed was a near-decade-long dollar down cycle. US twin deficits climbed sharply. A China-led EM and commodity boom, fueled by oil prices above 100, drew capital away from the US. Asian FX reserve accumulation recycled dollars into treasuries, but risk appetite for US assets took time to recover. The dollar rallied during the GFC, but resumed its decline until 2011. Is the Trump shock enough to break dollar inertia? The simultaneous political and economic shock wrought by President Trump's election may well be enough to break dollar cycle inertia. In fact, the administration may even want the dollar to go down, as some of their previous statements have indicated. Across the 6 historical cycles we examined in the paper, one pattern holds. The dollar doesn't turn until all 4 structural forces, geoeconomics and geopolitics, cross-border investment flows, rate differentials, and some kind of FX development shift. In each case, the alignment has triggered a multi-year trend reversal, and that alignment may now be forming again. Here's an examination of how the shock of President Trump's election might be enough to break dollar inertia along the lines of the 4 points we laid earlier. First, twin deficit blowouts seem to mark every major dollar peak, accelerating the need for a devaluation of the currency. And we think President Trump is probably on course to achieve this. In '85, the Plaza Accord came after Reaganomics pushed the combined twin deficit towards 15% of GDP. The 2002 dollar peak was also preceded by a sharp rise in twin deficits, which persisted to 2005. Even the 1970 down cycle was preceded by a jump to 2% on the twin deficit metric, which was unusual given that the US typically ran a current account surplus in this period. What we find is that twin deficits typically peak 2 to 3 years after the dollar down cycle has commenced, so the timing is not always exact. Today, President Trump's second-term policies, tax cuts, tariffs, and higher defense spending are projected to keep fiscal deficits above 6% of GDP into the late 2020s. Even if onshoring narrows the current account over time, external borrowing needs remain vast. Once global capital decides it can no longer fund the imbalance, as it did in 1985 with coordinated FX intervention and 2002 with the post-dot-com bust, the cycle typically breaks. Second, cross-border investment flows drive every dollar down cycle, and allocators are already overexposed to the US. Every major dollar downswing has featured a decisive pivot in capital flows. In the 70s, central banks shifted reserves into Deutschmarks, yen, and francs. In 1985 to 92, flows rotated towards Japan, Europe, and commodities. The 2002 to 2011 bear market repeated the pattern. EM equities outperformed, the euro rallied 25%, and a China-led commodity supercycle channeled capital into BRIC markets, draining demand for dollars and treasuries. These episodes confirm the rule. When investment flows pivot offshore, they create or amplify a feedback loop that prolongs every dollar down cycle. Today, concerns are mounting over the weight of US assets in global portfolios. The US share of ACWI peaked near 70% in 2024. Hedge ratios on dollar assets have fallen, and US-centric private assets are increasingly dominant in institutional books. It would not take much to trigger a meaningful reallocation. Third, rate differentials are likely to favor ex-US than the US. After 1985, the dollar slid for years as US rates fell relative to those in Germany and Japan. A similar compression followed the Fed's post-dot-com rate cuts in 2001 to 2003. History shows that when the carry flips, whether from Volcker-era highs to negative spreads with Germany in the early 90s, or from tech boom peaks to post-crisis easing in the early 2000s, capital reallocates and dollar down cycles become self-reinforcing. President Trump's tariffs could slow growth even as they raise inflation in the US. At the same time, he's pressuring the Fed to cut rates. And yet, as a result of his foreign policy, Germany is spending more, China is stimulating, and Japan is seeing a continuation of inflation normalization. The policy divergence that defined the 2010s could now narrow materially. Finally, weaponized policy accelerates reserve diversification for geoeconomic and geopolitical reasons. In many ways, this has been happening since 2017, so it's not a surprise, but it is still one of the main drivers of outcomes here. If you think back to the Nixon shock, with John Connolly's "Our dollar, your problem" mantra, that marked the first stirrings of reserve diversification as central banks began quietly reallocating into Deutschmarks, yen, and Swiss francs. A similar unease surfaced after 9/11 and the Iraq War, when US foreign policy again diverged from its allies. More recently, that discomfort has sharpened. Sanctions imposed on allies, such as the 2014 case against France's BNP Paribas for funding trade with Iran, and actions against geopolitical rivals, notably the freezing of Russia's central bank assets following the Ukraine invasion, have added urgency to de-dollarization efforts. These shifts are already visible. Major EMs and some US allies are settling energy and commodity trade in non-dollar currencies, developing digital settlement infrastructure, and broadening reserve holdings. Given the dollar's network effects, even marginal shifts in official demand can trigger outsized moves when private flows are already faltering. In conclusion, dollar cycles are longer than other financial or economic cycles. History shows they tend to last a decade or more because four reinforcing flows sustain and eventually break them. These forces are trade and geopolitical trends, relative growth and interest rate gaps, multi-year cross-border investment flows, and explicit or tacit currency intervention. Crucially, these factors don't operate in isolation. They tend to shift together in concentrated 2 to 3 year windows, locking in a self-reinforcing loop. We've examined 6 full dollar cycles since 1970. In every case, the trend only broke when all 4 levers shifted in unison. Trade frictions alone weren't enough in 2017, nor were yield differentials in 2020 and 2021 during the staggered COVID recoveries. Inertia persisted because the other gears kept turning in the same direction. What makes the prospect of a second Trump term different is that it pushes every lever at once. Wider twin deficits and tariffs disturb trade patterns, policy pressure on the Fed and economic recoveries in China, Europe, and Japan, not to mention genuine technological innovation outside the US, narrows interest rate differentials, while allies openly discuss coordinated responses. That alignment, we think, gives the dollar its first genuine opportunity for a sustained down cycle since 2002.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to the Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.